Disclaimer.
January 26th, 2026, a Sunday morning. While most Americans were planning their week ahead, silver quietly did something it hadn't done in over 45 years. It broke through $117.75 per ounce, the all-time nominal record, not adjusted for inflation, just pure hard numbers on the screen. If you own physical silver right now, think about what that means for a moment. 1 year ago, in January 2025, silver was trading around $30 an ounce. Today, it's sitting near $114. That's a 274% gain in 12 months. You nearly tripled your money while the stock market delivered single-digit returns. So you'd think this would be front-page news across every financial publication in America, right? You'd expect CNBC to run special coverage. You'd imagine the Wall Street Journal would dedicate their weekend edition to understanding what just happened. But here's what's strange. The silence has been deafening. A few brief mentions, some technical analysis about resistance levels. But no one's asking the question that should be keeping financial analysts up at night. Why did this happen now? And more importantly, what does Washington know that we don't? Because while retail investors were celebrating record silver prices, something very different was happening behind closed doors in our nation's capital. And it started months before silver ever touched $100 an ounce. Let me take you back to October 2025. Most Americans were focused on the upcoming holiday season. The news cycle was dominated by political debates and international tensions. But on October 24th, a report landed on President Trump's desk. Not a particularly long document, not filled with dramatic language, just a straightforward assessment from the Department of Commerce about critical minerals. The title was bureaucratic and forgettable. The contents were anything but. According to this report, which was later released through a White House proclamation, processed critical minerals are being imported into the United States in such quantities and under such circumstances as to threaten to impair the national security of our country. Let me repeat that phrase. Threaten to impair the national security of the United States. This wasn't about economic competitiveness. This wasn't about trade imbalances. This was about national security, and silver was on that list, right alongside lithium, rare earth elements, and other materials most people have never heard of. The proclamation named roughly 40 minerals in total. But silver occupies a unique position. It's not just used in defense systems, though it absolutely is critical for radar, missiles, drones, and advanced weapons platforms. It's also the backbone of our push toward energy independence through solar power. It's essential for the electric vehicle revolution that every major automaker has bet billions on. And it's increasingly vital for the artificial intelligence infrastructure that powers everything from cloud computing to national security networks. Here's where it gets interesting. The White House didn't just identify the problem and move on. The proclamation specifically instructed the Secretary of Commerce and the U.S. Trade Representative to pursue negotiation of agreements with foreign suppliers. And here's the phrase that should make every silver investor pay attention. In negotiating, they should consider price floors for trade in critical minerals and other trade-restricting measures. Price floors. Think about what that means. Our government is considering guaranteeing minimum prices to foreign suppliers to ensure we have access to silver, not maximum prices to protect consumers, minimum prices to secure supply. When was the last time Washington volunteered to pay more for anything? Now fast forward to January 2026. According to sources familiar with the negotiations, the Commerce Department has been conducting urgent bilateral talks with Mexico, Peru, and Chile. These three countries alone produce about 45% of the world's silver. Mexico is number 1. Peru is number 2. Chile sits at number 3. And right now, American officials are in rooms with their counterparts discussing terms that would have seemed unthinkable just 2 years ago. A leaked memo that circulated among commodity analysts in mid-January suggested that our government is exploring guaranteed minimum purchase agreements. Essentially, we would commit to buying specific quantities of silver at predetermined prices, regardless of what the spot market is doing. For a government that usually drives hard bargains in trade negotiations, this represents a complete reversal. We're not demanding lower prices. We're offering to pay premium prices just to guarantee access. Why would we do this? What could possibly justify this kind of urgency? The answer connects directly to what happened on January 27th, just 1 day after silver hit its record high. President Trump appeared at a press conference. A reporter asked about the dollar's recent weakness. Over the previous weeks, the U.S. dollar had fallen to 4-year lows against major currencies. Normally, an American president would express concern. They'd talk about the importance of dollar strength. They'd reassure markets. Trump did the opposite. He stated publicly that he was unconcerned about the dollar's decline. He suggested it would help American exporters compete. And then something remarkable happened in the silver market. Within hours, silver surged 6% in a single trading session. It jumped from $108 to $114. Gold also rallied, but silver's move was far more dramatic. Because traders understood something that many retail investors missed. A weaker dollar doesn't just make exports cheaper, it makes hard assets more valuable. And if the administration is comfortable letting the dollar slide while simultaneously scrambling to secure silver supplies at any price, that tells you everything you need to know about where they think this is heading. Think about the logic chain here. Our government declares silver a national security priority. They start negotiating to pay above market rates for guaranteed supply. The president signals he's fine with a weaker dollar, which automatically pushes precious metals higher. And all of this is happening while silver is already trading near all-time highs. They're not waiting for a dip. They're not trying to time the market. They're acting like people who believe $117 is going to look cheap very soon. But here's what most Americans don't understand about silver. This isn't like oil, where we can drill more wells if prices get too high. This isn't like copper, where increased mining investment can eventually boost supply. Silver has a unique problem that makes this crisis fundamentally different from any commodity shortage we've seen before. For 6 consecutive years, from 2020 through 2025, the world has consumed more silver than it mined. Every single year, we've run a deficit. According to the Silver Institute, which tracks global supply and demand, that deficit reached 215 million ounces in 2024 alone. To put that in perspective, total annual mine production is only about 800 million ounces. We're consuming 25% more than we produce, and that gap is widening. Where's the extra silver coming from? Above ground inventories, stockpiles that were built up over decades, reserves held by governments, banks, and private investors. But those stockpiles are finite, and they're depleting faster than most people realize. The available silver in COMEX warehouses, which are the primary delivery point for silver futures in North America, has dropped dramatically over the past 18 months. We're drawing down reserves that took generations to accumulate. Now here's where Washington's panic starts to make sense. Industrial demand for silver isn't optional. You can't build a solar panel without it. The average panel uses about 20 grams of silver, and there's no viable substitute that works as efficiently at conducting electricity. Global solar installation is projected to double between 2025 and 2028 as countries race to meet climate commitments. That alone will consume roughly 20% of annual silver production. Electric vehicles use about twice as much silver as conventional cars because of all the electrical systems, sensors, and battery management components. As EV adoption accelerates, that's another 15% of supply locked into automotive manufacturing. And then there's the newest demand driver that almost no one is talking about: artificial intelligence data centers. These massive computing facilities that power everything from ChatGPT to national security systems require enormous amounts of silver in their server components and cooling systems. A single, large-scale AI data center can use as much silver as a medium-sized solar farm. And tech companies are building these facilities as fast as they can to meet exploding demand for AI services. According to industry analysts, this new source of silver demand could consume 8 to 10% of annual production within the next 2 years. Add those up. Solar takes 20%, electric vehicles need 15%, AI infrastructure wants another 10%. That's 45% of global silver production locked into industrial applications that are not optional and not reversible. You can't unbuild a solar panel. You can't extract silver from an electric vehicle once it's manufactured. That metal is gone from the market forever, which leaves only 55% of supply for everything else: investment demand, jewelry, electronics, medical devices. And now potentially large-scale government buying to build strategic reserves. Do you see the problem? If Washington enters this market as a major buyer, competing with investors and industries for that remaining 55% of supply, what happens to the price? This is why they're panicking. Because they ran the math. They know that defense contractors need silver for missile guidance systems. They know that the Department of Energy's Solar Independence Plan requires massive silver supplies. They know that our entire strategy for energy security and technological dominance depends on having access to this one metal. And they've realized that at current consumption rates, the market fundamentals are about to break. When the government declared silver a national security issue in October, they weren't being dramatic. They were being honest. And when they started negotiating to pay premium prices in January, they weren't being wasteful. They were being realistic. Because what's coming next is a normal commodity cycle where high prices eventually bring out more supply. What's coming next is a supply crisis where no amount of money can instantly create more silver. The mines that will produce silver in 2027 and 2028 are already operating. There's no secret reserve of undiscovered deposits that can be brought online quickly. Silver mining is often a byproduct of copper, lead, and zinc mining, which means you can't just decide to mine more silver without fundamentally changing operations across the entire mining industry. That takes years and billions in capital investment. So here we are. Silver at $117, Washington scrambling to secure supply at any cost. Industrial demand accelerating, above-ground inventories depleting. And a weaker dollar making every ounce of precious metal more valuable in dollar terms. The smart money isn't asking whether silver can go higher. They're asking how high it can go before something breaks. And more importantly, they're wondering what Washington knows about the supply situation that hasn't been made public yet. Because if our government is willing to pay premium prices now, while silver is already at record highs, what does that tell you about where they think the price is heading? If they're declaring this a national security emergency while the metal is trading at $114, what level would constitute a full-blown crisis? 150? 200? Higher? The next time you see a solar panel being installed or an electric vehicle driving past, or hear about a new AI breakthrough, remember this. Each one of those innovations requires silver, and each ounce used is one less ounce available for everything else. Washington has done the math on this. They know what's coming. The question is whether you're paying attention. Now, I know what some of you are thinking. Maybe Washington is overreacting to a temporary supply blip. So let me show you exactly why this time is different. Because while American officials were quietly negotiating behind closed doors, something extraordinary happened on the other side of the world that proves the global silver crisis is already here. January 2026, Shanghai, China. A major silver investment fund suddenly suspended trading, completely shut down. The reason? Demand had become so intense that the fund's market price exploded to 40% above its net asset value. Chinese investors were paying $140 for every $100 of actual silver the fund owned. They knew they were overpaying. They didn't care. According to Bloomberg and Reuters, jewelry manufacturers completely pivoted their production lines. They stopped making necklaces and started churning out 1-kilogram bars as fast as they could cast them. People who had never owned precious metals were lining up to buy silver in any form available. And during the most acute shortages, silver lease rates in Shanghai spiked to 30 times normal levels. That's not a supply disruption. That's panic. This is China, the world's second largest economy, a country that produces 15% of global silver supply. If they're experiencing shortages this severe, what does that tell you about the global situation? Now let's look at what happened in the West. While Chinese investors were mobbing silver funds, the world's largest stablecoin issuer was making a $24 billion mistake. Tether, the company behind USDT, has been on a massive gold buying spree. According to disclosures confirmed yesterday, they now hold 140 tons of physical gold stored in a Swiss nuclear bunker. They're buying 2 tons per week, over $1 billion per month in gold purchases. But here's the part that should make every silver investor smile. Tether owns exactly 0 ounces of silver, not 1 bar. They put $24 billion into gold and completely ignored silver. In 2025, gold delivered 90% returns. Spectacular performance. But silver gained 170% in that same period. It nearly doubled gold's gains. Let me put this in concrete numbers. If Tether had allocated just 10% to silver, that's $2.4 billion. At January 2025, prices of $30 per ounce, they could have bought 80 million ounces. Today, those would be worth $9.1 billion, a profit of $6.7 billion on a 10% allocation. Instead, they followed conventional wisdom and completely missed the opportunity. And they're not alone. Central banks bought 297 tons of gold in 2025, according to the World Gold Council. But reported silver purchases? Essentially 0. The entire institutional world made the same bet. Now here's why this matters. When these players realize their mistake and decide to rebalance even partially into silver, this market cannot absorb that demand. According to Jefferies, institutional silver ETF inflows in Q4 2025 already exceeded all of 2024, and that was before silver broke $100. Now let me take you back in time, because if you want to understand where this is heading, you need to see how this played out before. 1979 to 1980, the last time precious metals went into genuine mania. In 1979, gold traded around $500 per ounce. Silver was stuck at $6. Gold seemed like the obvious choice. It was moving, getting headlines, the smart institutional play. Silver just sat there looking irrelevant. Then something shifted. Inflation accelerated. The dollar weakened. The Hunt brothers started accumulating massive silver positions because they understood the fundamentals. By January 1980, 18 months later, gold climbed to $850, a 70% gain. Spectacular. But silver touched $49.45. Starting from $6, that was over 720%. While gold moved 70%, silver moved 720%. It obliterated gold's returns. Now compare that setup to today. Back then, industrial demand was only 30% of consumption. Today, it's over 50%, Back then, the deficit was temporary and speculation-driven. Today, we have 6 consecutive years of structural deficits from irreversible industrial use. Back then, it was mostly private investors. Today, we have investors, plus industries, plus governments, all competing for shrinking supply. And here's what makes today even more explosive. In 1980, when silver hit $50, the COMEX imposed Silver Rule 7 and banned margin buying. That killed the rally. But today, our government has declared silver essential to national defense and energy independence. Can you imagine exchanges imposing restrictions while the Commerce Department begs suppliers for guaranteed access? The regulatory environment that killed the 1980 rally doesn't exist anymore. One more critical difference. In the late 70s, when prices climbed, mine production responded quickly. New projects came online. Supply stabilized the market. Today, silver mine production peaked in 2016 at 900 million ounces. Despite prices tripling, we're still at 800 million ounces annually. Why? Because most silver is a byproduct of copper, lead, and zinc mining. You can't just mine more silver. That takes years and billions in capital. Here's what all this evidence tells us. China is experiencing shortages so severe that lease rates spiked 30 times normal. The world's largest stablecoin issuer missed silver's 170% rally by betting everything on gold. The 1979 to 1980 precedent shows silver can move 700% in 18 months, and today's setup is objectively stronger. Mining production cannot respond quickly even at these prices, and governments need high prices to secure supply, so they can't intervene like they did in 1980. This isn't speculation. This is what's actively happening right now. The Chinese understand it. Institutional money is starting to understand it. Mining executives understand it. Our government clearly understands it. The only question that remains is mathematical. If these forces continue, where does the price actually go? And that calculation is exactly what we need to examine next. Let's do the math. Not hopeful speculation, not hype. Just cold, logical calculation based on what's actually happening in the market right now. Because the $200 target isn't some arbitrary number pulled from thin air. It's what the fundamentals are screaming at anyone willing to listen. Start with the conservative case. Goldman Sachs, one of the most respected investment banks on Wall Street, has a 2026 price target for gold at $6,000 per ounce. That's not some fringe analyst. That's Goldman. Now take the gold-silver ratio. Historically, over the past century, it averages around 60 to 1, meaning you need 60 ounces of silver to equal 1 ounce of gold. If gold hits 6,000 and the ratio returns to that 60 to 1 historical average, silver lands at $100 per ounce. But here's where it gets interesting. We're not at 60 to 1 right now. We're at 47 to 1. The ratio has already compressed significantly from the 88 to 1 we saw just months ago. If that compression continues to 40 to 1, which happened during the 2011 silver rally, suddenly you're looking at $150 per ounce. But that's assuming gold only reaches Goldman's target and stops there. What if gold continues climbing to $6,500 or $7,000? What if the dollar weakness Trump signaled continues? What if inflation proves stickier than the Fed expects? At $7,000 gold with a 40 to 1 ratio, you're at $175 per ounce for silver. Now add one more variable that almost nobody's pricing in yet: government buying. The Commerce Department is negotiating guaranteed purchase agreements with major producers. Let's say those agreements add 50 million ounces of new demand. That's only about 6% of annual production. It doesn't sound like much, right? But remember, the market is already in deficit. Industrial demand already exceeds new supply. Adding another 50 million ounces of government buying into a market that is already short creates a genuine supply shock. When supply shocks hit commodity markets, prices don't move linearly. They gap. According to commodity trading history, supply shocks typically drive prices 20 to 30% above fair value before stabilizing. If fair value based on the gold ratio is $150, a supply shock could easily push toward $180 to $200 range. That's not mania pricing. That's simple supply and demand economics when too much money chases too little material. So the $200 calculation for 2026 isn't crazy. It's actually conservative when you layer in all the variables we've discussed. Gold at 6,000, ratio at 40 to 1, plus modest government buying pressure. You hit $200 almost mathematically. The question isn't if it can happen. The question is what could accelerate or delay that outcome. Let me give you 3 scenarios based on how the next several months unfold. Think of these as roadmaps for what to watch. Scenario 1 is the base case. Gold grinds higher throughout 2026, eventually reaching that $6,000 to $6,500 range by late in the year. The gold-silver ratio slowly compresses as more institutional money realizes silver is undervalued. Government buying stays relatively quiet and strategic, no major supply disruptions. Under this scenario, silver reaches $150 to $175 by the fourth quarter of 2026. Timeline? Probably August through October. That gives the market time to digest the national security implications and for industrial demand to keep growing steadily. Scenario 2 is acceleration. This is where things get more dynamic. One of the top 3 silver-producing countries implements export restrictions. Mexico threatens this in response to U.S. tariffs. Peru faces political pressure to prioritize domestic needs. Chile wants silver for their own battery manufacturing. If any one of them restricts exports, even partially, the market goes into immediate shortage. Additionally, let's say the U.S. government announces a formal strategic silver reserve, similar to the strategic petroleum reserve. That changes everything overnight. Suddenly everyone knows the government is competing for supply. The gold-silver ratio compresses faster, potentially to 35 to 1. And here's the kicker. What if Tether and other institutional players realize their mistake and start rotating even 5% of their gold holdings into silver? Under this scenario, you hit $200 much faster, potentially by June or July of 2026. Scenario 3 is the mania case, and I want to be very clear about something. This is the low probability but high impact scenario. It's what happens if multiple cascading events hit simultaneously. The COMEX experiences a delivery default because too many paper contracts demand physical settlement and there isn't enough metal to deliver. We saw this almost happen in the London gold market in 2020. If it happens in silver, the spot price could gap 20 to 30% overnight. Combine that with dollar losing significant reserve currency status as other nations accelerate their de-dollarization efforts. Add government-mandated price floors at $180 per ounce to guarantee domestic supply. Then layer in retail FOMO that matches 1980 intensity when regular Americans were lining up to buy silver coins. Under this scenario, $300 or higher becomes possible by late 2026 or early 2027. Now, I'm not predicting scenario 3 will happen, but I am saying the mechanisms that could trigger it all exist right now in the market. They're not theoretical. The COMEX margin requirements have already been raised 3 times in January, which is exactly what happened before previous market stress events. De-dollarization is accelerating according to International Monetary Fund data. Price floors are being discussed in Commerce Department negotiations, and we've already seen FOMO buying in China. All the ingredients are present. Whether they combine into a perfect storm is unknowable, but ignoring the possibility would be irresponsible. Here are the specific dates and events to watch over the next several months that will tell you which scenario is unfolding. February 15th, 2026. That's when the Commerce Department releases its updated critical mineral strategy. Pay attention to the language around silver. If they increase the urgency or announce specific purchase targets, that's a signal acceleration is beginning. March brings Peru's elections. A leftist candidate has promised mining nationalization. If they win, expect market volatility as traders price and potential supply disruptions. May is Mexico's deadline for export control decisions related to U.S. tariff negotiations. This is arguably the most important single event of the year for silver since Mexico produces over 20% of global supply. June brings the next Federal Reserve decision on interest rates. If they continue cutting despite inflation remaining above target, precious metals typically accelerate. September is historically the strongest month for silver due to back-to-school electronics demand and industrial restocking. If we're in an acceleration scenario, September could see explosive moves. So what should you actually do with this information? Let me be very direct. If you currently hold silver, you made the right decision at $30, at $50, at $80, and at $100. Every single time the market told you to sell, you were smarter than the market. The 1980 rally had 5 moments that looked like the top. Each time, holders who sold early missed the real peak. Your job now isn't to predict the exact top. Your job is to have a plan. Some investors use a scaling approach. Sell 10% of holdings at $150, another 10% at $175, another chunk at $200. That way you lock in profits while maintaining exposure if the mania scenario unfolds. Others hold physical silver as pure portfolio insurance and never sell regardless of price. Both strategies are valid depending on your personal situation and risk tolerance. If you missed the rally from $30 to $117 and feel like you're too late, consider this perspective. In 1979, silver rallied from $6 to $12. People thought they missed it. Then it went to $49. If you had bought at $12 thinking you were late, you still would have made over 300% returns. Right now, if the math we just walked through is even close to accurate, buying at $115 and selling at $200 is still a 73% gain. How many investments can you name that offer that potential over the next 6 to 9 months? But here's the critical part. Don't overallocate. Financial advisors typically suggest precious metals should represent 10 to 15% of a diversified portfolio at maximum. That guidance exists for good reason. Silver is volatile. It can drop 20% in a week, then recover and hit new highs the next month. If you can't stomach that volatility, then you shouldn't be heavily concentrated in silver regardless of the fundamentals. Any pullback to the $100 to $105 range would represent a significant buying opportunity in my view, based on everything we've analyzed. That would be silver coming back to test previous resistance as new support. It would be healthy consolidation before the next leg higher. If we get that dip and you've been waiting on the sidelines, that's probably your entry point. Here's what Washington knows that they're not announcing publicly yet. The silver supply crisis is not temporary, it's structural. Every solar panel installed locks away silver forever. Every electric vehicle built consumes silver that will never return to the market. Every AI data center constructed needs silver in quantities that didn't exist in previous technology cycles. And mine production cannot respond quickly enough to change the trajectory. They know that the above-ground inventories that have cushioned shortages for the past 6 years are depleting rapidly. They know that if they don't secure supply agreements now, at prices that seem high today, they'll be forced to pay even higher prices later when the crisis becomes undeniable. They know that the gold-silver ratio at 47 to 1 is historically compressed and could go much lower if industrial demand continues accelerating. Most importantly, they know that silver at $117 is not expensive relative to what's coming. It's a checkpoint, a milestone on the way to wherever this cycle ultimately peaks. The fact that they're willing to negotiate premium purchase prices right now, while the metal is already at all-time nominal highs, tells you everything about their internal price forecasts. In 1979, the smart money bought silver at $6 and sold at $40, thinking they were geniuses. They made 667% returns and felt brilliant. But the truly smart money, the people who understood the fundamentals rather than just trading the chart, held until $49. They made over 800%. The difference between being smart and being right was understanding that the supply deficit wasn't solved at $40. It was solved when the exchanges changed the rules and killed the market artificially. Today, we're at a similar crossroads. Silver at $117 looks expensive to people anchoring to the $30 price from last year. But to people who understand that industrial demand is permanent, supply is constrained, government buying is just beginning, 117 looks like the early innings of something much larger. The question you need to ask yourself isn't whether silver can go higher from here. The evidence overwhelmingly suggests it can. The question is whether you're positioned to benefit when it does, whether you have a plan that matches your risk tolerance, whether you are paying attention to the signals that will tell you which of those 3 scenarios is unfolding in real time. Washington has done the math. They've run the scenarios. They've looked at the supply and demand fundamentals and decided this is worth declaring a national security emergency. They're negotiating to pay premium prices at what already look like premium levels. They're not doing that because they're wasteful. They're doing it because they know what $117 silver means. It means the crisis is here and $200 is next.